In this video, I'm going to explain how and why markets react the way they do whenever we get bad news. So if you think back to February, March 2020, during the height of the coronavirus pandemic, when the world was going into lockdown for the first time, we saw the global stock markets fall by about a third, or back longer in time to the great financial crash, the credit crunch, when governments around the world were having to bail out the large banks that we believed were too big to fail but were suddenly failing, and longer back, start of the turn of the century, during the tech bubble bursting, and then moving into the Second Iraq War. These were big stock market events in recent times where we saw very sharp, sudden falls in the value of the stock markets over the course of weeks and months. And it doesn't matter what the trigger is, it'll always be a different trigger. But what happens is, whether it's a banking crisis or a natural event like a volcanic eruption, or a tsunami leading to, as it did in Fukushima, the closing down and the risk of a nuclear event, could be a biohazard, a virus like coronavirus, a war, a terrorist event. As I said, the trigger always is different, but investors collectively and individually think, well, what does this mean for our money? Are we going to lose money now? Are the companies we're investing in suddenly at risk because they're not going to make the profits, they're not going to make the sales? So therefore the risk return basis is now completely flipped, and if they're not going to make money, it means that we can't make money on those investments. And we get this herding mentality when the markets as a whole begin to fall because investors are selling out, and once they start to sell, the prices fall, so more people panic, and it's this stampeding effect as people get panicky and then sort of sick in the stomach, think we're going to lose money, so we need to get out as well. We don't want to be the one holding the baby in the bathwater. But then what happens is market prices get so low that people stop to think, say, well, was that trigger as bad as we thought? Have we got now got new information that changes the perspective, changes the narrative, and actually things aren't as bad as we thought? Or is it that the prices have got so low, actually it now looks, stock market prices collectively or companies on an individual level actually look like they're a good investment because we can buy it at a low price, and the expected return going forward is now much better than it was when the prices were higher. So once they go through this reflection phase, people start buying again and prices rise, and then we get that momentum on the upside as people think, well, these stock markets are making money, these companies are making money, therefore we want to own shares, and so we can benefit from that positive movement upwards as well. And so the cycle continues. But it's always that trigger event that causes markets to panic and sell and lose value, to the point that they get so low that the information flows change, and we get that flip back to the more positive side. So I hope that helps. I hope that explains why markets react to bad news. So the next time we go through such an event, you can look with a bit more context and understanding that it's never as bad as it first appears. If you've got any questions, let me know.